The best time to invest was yesterday, and the second best time to invest is today. I know, in this 2022, a lot of people have been talking about invest your money, grow your wealth. And you're probably sitting on the other side of the screen saying, I don't even know how to get started. Am I too early? Is it too early for me to start investing? Am I too late to start investing? Am I too old? Am I too young? How do I even get started? Do I need a huge amount of money to get started with investing? How much do I even need to get started? In this video, I'm going to be answering all of those questions, and hopefully by the end of the video, you, my dear friend, can completely understand what investing is and can be on your way to get started with investing. So let's get right into this video. So first, let's start by defining what an investment is. An investment is an asset or an item acquired with the goal of generating income, over time. That's pretty much the definition of an investment. Before we even get started into the different types of investments and how you can get started with investing, I'd like to encourage you to please take seriously these 3 preliminary steps before getting into investing. Number 1 is for you to pay down your debts. It's very, very important for you to make sure that you pay down your debt, because if you're putting money towards investments, right, and you're not paying down your debt, it's pretty much going to be like the same, because you're taking out money to pay down high interest debts, and then you're also putting money towards investment that you can't really get out anytime you want. If not, you might lose, which we're still going to get into it. It's very, very important that you first pay down high interest debts, high interest credit cards, so that you can kind of settle those areas and you don't have to worry about it. And then while your money is also growing in investment, so it's important that you pay down your credit card debts, you pay down any high interest debts pretty much before you get started with investing. The second thing that I'd encourage you to do before you get started with investing is to build an emergency fund savings. I talk about this a lot in my previous videos. It is very, very important for each and every one of us to build an emergency savings fund. Just pretty much self-explanatory, for the sake of emergencies, right? Things can happen. A lot of people don't know that the United States, the inflation rate in the United States from between January and April 2022 has grown to 8.5%. People don't know. A lot of things are expensive. Your money is losing value. From you putting that money in the bank, it's losing value. But then it's important for you to build emergency savings funds, because anything can happen. The country can go into recession. We're not praying for that. But then if you have any major expenses, you don't have to worry about getting from your investments or trying to sell a stock, right away that you just bought because you didn't, make enough provisions for that. And for emergency savings, I always encourage people to have 3 to 6 months worth of living expense in your emergency savings. So if it's going to cost you $3,000 to pay all of your bills in a month, then I always encourage you to multiply 3 times 6 or 3 times 3. At least having $18,000 in your bank account will be a great way to start with emergency savings, and you can build this over time and continue to add more money. And then the last thing that I want to encourage you to do is also to get started with retirement, investments or a 401k, at least to get started with that, or a Roth IRA. That's actually part of investing, but I'll explain that, as soon as we proceed in the video. Pretty much, so you want to make sure that you do those 3 things: pay down debt, have emergency savings, and also start to build retirement savings. So now let's get into investment. So back in 2016, right, I got a job with the state of Maryland, and that's where my investment story got started from. So I started investing when I was 22, and I considered that a little late. Like, if I know what I know now, I would have started investing like when I was like 6. Hello, but it's never too late. So I started investing there. So towards my retirement investment, which is also another type of investment. So they'll take out like a certain portion of my salary and put it towards my investment every month, and then they will also match that. So that was similar to a 401k, but no, it wasn't really a 401k. It was more like a pension system with the state of Maryland. That's how I got started. And then in that same year, I got introduced to Acorns. So Acorns is an app, an investment app where you can pretty much invest every month. So let's say, for instance, so they pretty much round up every dollar that you spend and put the difference between the cents and the dollar towards your investment. For instance, you get gas for, let's say, $2.30. So Acorns will, kind of deduct the difference between 30 cents and $1, which is 70 cents, and put that cent towards your investment, right? Because that money is such little money that you don't even feel it when it's taken out of your account, right? As opposed to you dropping $700 or $70, you know, towards investing. If it's something like a cent that could just be rounded up, it was always easy for me to just, you know, let go. So I started with that, and then I also started to put a certain amount of money towards investment. You know, they'll take it out every month, and then diversify my portfolio, and then use it to invest in other businesses as well. And I let that money grow. When I got part of the money out in 2020, it was like a really big money that I wasn't even expecting, because I started investing, you know, at such a young age. I think I got it out about 5-6 years later, which is pretty good. All right, so now we're done with that. Pretty much that's how I got started with investing. And then in 2019, I bought Bitcoin. I didn't buy the entire Bitcoin, but then I bought, you know, Bitcoin, and, you know, Bitcoin really grew over the pandemic, and also did my money grow. So I'm like, wait, this investment thing is actually really paying off. So why not get into it and really get into finance fully? So that's my little investment story. All right, so you're probably watching me and saying that, okay, I've heard, can we get into the video? All right, so there are different types of investments that you can venture into. We're gonna start with the retirement investment, which I said I was gonna elaborate on earlier. So with retirement investment, a lot of you are probably familiar with 401k or Roth IRA. So we're gonna focus on 401k for the sake of this video. A 401k is pretty much an retirement investment account that your employer sets up for you, and you are supposed to contribute a certain amount of money towards that account, and then your employer matches pretty much, you know, however amount you're contributing, up to a certain percent of your income. So let's say, for instance, some employers will say, oh, I'll contribute 4% of your income every year. You know, I'll contribute full whatever you're contributing. I'll match it up to 4% of your income, or up to 8% of your income, pretty much every year. And there's a limit on how much you can contribute towards your 401k. In case you didn't know, for the year 2022, you can max out your 401k up to $20,000. If you contribute more than that, the tax people, Uncle Sam, they're gonna charge you, so you want to be careful of that. But I mean, it's got limits, but still, it's definitely a great way to contribute $20,000, and that's excluding what your employer is matching, so which is great. So you could be having $40,000 a year with 401k investment. And pretty much the way you can diversify your portfolio is to use whatever company, you know, is responsible for your 401k. For instance, let's say I use Fidelity. I log into my Fidelity with my credentials. I try to diversify my portfolio into different industries, basically. So I could put like 20% of my total portfolio towards real estate. I could put 10% towards gas. I could put 10% towards tech. I could put 10% towards communication, you know, just so that in case real estate crashes, right, I can still be making my money. I can still be, you know, growing my investments with gas, with communications, with tech, with all of these different industries, pretty much. So that's how I diversify my portfolio. I log into whatever app, or you can also call the company that's in charge of your 401k and just tell them that you'd like to diversify and just kind of break that money into different places. So let's say, for instance, you've been able to contribute $20,000 or $30,000 towards your 401k. You can kind of diversify that money into different industries, and it keeps growing. So as you know, as their stocks are growing, your money is also growing as well. You're also getting some type of incentives as well over time, as opposed to just it being the only thing that you're contributing, right? Nothing is growing, it's just whatever you're contributing. So that's another way to actually build wealth. So now we're done talking about 401k, and I just want to encourage you, if you're watching this video right now and you're not tapping into your company's 401k, I want to encourage you to please start to do it now. It's never too late, but please start to do it. And the beautiful thing is that the money is going to grow over time. It's going to, you know, it's going to compound interest, or the interest is going to compound over time. And then before you know it, maybe by the time I'm like 50, right, I could be having like $800,000 in 401k, you know, because I'm diversifying and because I keep contributing towards 401k as well. And that's a great return. That's a great money to actually get started with, at least retiring, right? So that's that with 401k. So the next thing I'd like to encourage you to look into is actually mutual funds. So there's mutual funds and there's index funds. So basically what I understand, mutual funds is like, you know, having stocks, right, from different companies. Pretty much, instead of individual stocks, now you have multiple stocks, right? And then one person is pretty much managing your stocks, and you're pretty much paying that person for managing your stocks, you know, for managing the growth and just pretty much tracking it. So that's pretty much mutual funds. My favorite, I'll always talk about, is index funds, right? This, you also have multiple stocks with different companies, but then you are pretty much like managing it yourself, so you're not paying charges to nobody. And one of my favorite under the index fund is S&P 500. If you're in the United Kingdom, I think it's called S&P 100. I can't really remember, but pretty much S&P 500 is pretty much you investing into the largest 500 companies in the United States. Can you imagine that? So let's say, for instance, you know, I'm investing with $500 into S&P. So that $500 would be broken down into 500 different companies in the United States. So pretty much I have a stock with 500 companies, 500 of the largest companies in the United States. That means I have a stake, I have a stock in 500 companies in the United States. And guess what? Even if one company like crashes, right, out of 500, not all 500 companies are going to crash, and as their stocks, as the value of the company is increasing, I'm also getting an incentive for being a stakeholder or for being a stockholder as well. So I consider this one of like the safest, you know, and pretty much based off of my research and also from my own personal experience, S&P 500 has a return of about 8.5% to 10% interest every year. So that means as you're contributing towards it, maybe you start with $500 and then you start to put $200 towards it, there's a high probability or guarantee that you're gonna get at least 10% or 8.5%, you know, over increase pretty much over what you are already contributing. And over time, this money, you know, this interest compounds, this money compounds and it grows. So if you're to contribute, let's say $30,000, in 10 years, you could be getting $147,000 from S&P 500, just living it over there. And my advice for you would be always think about investment, this type of investments in long term. If you go back to the beginning of the video, that's why I talked about it is important for you to have emergency savings so that you don't keep dipping and digging into your investments, because investments really are for long term, not short term. So if you're over here trying to buy a house next year, I don't know, I wouldn't really encourage you to, you know, put your money towards like investment, because the market can go up and down, the market can crash. Yes, it does, but then over time, it's been proven, right? If you live your investment for over time, 10, 5, 15 years, then it will definitely grow more than what you had initially put in. The third investment type would definitely be to invest in stocks. So you can invest in stock. Investing in stocks means that you are a part holder or a shareholder of a company. Let's say, for instance, you invest in Amazon, which is a pretty big company. I think right now Amazon stocks are going for about $3,000. But the beautiful thing is that you don't even have to buy a whole stock to get started. You can invest with as little as $100, and you have part of Amazon stocks in your portfolio. A stock and being a shareholder of that company. So as the company's, you know, worth and it's increasing, right, your own stocks also will continue to increase. So you've probably heard stories of how people bought Amazon stock for $100 back in 1999, and now look at how much it's worth, and they probably bought multiple. So buying a stocks is like also, you know, having a share in a company, and then as the company grows, as their income grows, then your own wealth also continues to grow. So there are different stocks that you can, you know, look up, that you can check out or start buying. There's Amazon. There's just so many stocks, you know, out there that you can pretty much buy. Stocks are pretty much individuals. That's the difference between stocks and S&P 500. And S&P 500 is buying multiple, you know, stocks, or buying one stocks, but then diversifying into different companies. But then a stock is just one. Now let's get into the fourth and the final one, which is cryptocurrency, investing in crypto. So guys, I only know about two: Bitcoin and Ethereum. All of this other stuff, Dogecoin, Coinbase, I don't know nothing about it. I only know two. Okay, and like I mentioned earlier, I did buy Bitcoin back in 2019, and then also we are also investing in Ethereum as well. So pretty much, I don't know, but based off of my research, right, this crypto thing, it's just pretty much digital currency, right, that you can spend anywhere in the world without having to convert to US dollars or without having to convert to pounds. So it's pretty much a digital currency that you can use to make, you know, purchase anywhere in the world, right? So it would get to a point where, you know, you're trying to be buying. I heard now that you can even buy Tesla with the crypto. I think that's amazing. So pretty much, you know, it goes up and down, up and down, up and down, up and down, however they say. But I'll definitely encourage you to invest in crypto. It's a fast way to make money. It's of higher risk because it can drop at any time, as opposed to S&P 500 being of lower risk, right? Because that's more structured. pretty much a fast way to make money with a higher risk. So you can put in, you know, you can buy an Ethereum. Ethereum right now is $3,000. You can buy Ethereum today for $3,000, and I think Ethereum is projected to be worth $9,000 by December 2022. And currently, right now, Bitcoin is worth $47,000. As at 2020, guess what? Bitcoin was worth $60,000. It can drop, and then over time, it can also grow as well. But it's actually a fast way of making money, but it's a lot of risk. I would not encourage you to put all of your money into crypto, but I would definitely encourage you to diversify your portfolio just so that you are on the safe side. And yes, I would definitely encourage you to get started in Bitcoin or Ethereum or any other crypto that you are comfortable with. There are a lot of YouTubers who are great resources, you know, who are really gurus when it comes to crypto. There are a whole lot of them on YouTube that you can pretty much search up, and they'll be able to answer whatever crypto questions you have. All right, so I hope you've been able to learn from this video. And should I add this, that, you know, investors always say that crypto is pretty much for short term, right? Because the downsides of crypto is that there's really no body of, you know, people who are governing or regulating, you know, how much it should be worth. So it's pretty much volatile. You know, it could be up today and down tomorrow, and that's one of the major risks. But when it comes to making fast money, not easy money, remember, we want to make fast money, not easy money. We're not looking for an easy way out. You know, we want to make fast money. Crypto is definitely a great one. So it's part of the high risk, you know, investments that you can make, as opposed to S&P 500, where it's like the higher the risk, you know, the more the money. But you got to be careful out there. I hope this video has been super informative, and I hope that you've been able to enjoy the video as well. Even if you don't, still hit the subscribe button. Okay. All right, and remember to follow me on my social media. Remember to follow me on IG at Fabulous Opie, and TikTok as well. I got lots of great contents coming on TikTok, so you definitely want to follow me. And I will see you in my next video. Happy investing. Bye.